Hi, everyone. It's John Pokerova again. It's time for a general market update. Today is Friday, October 28th, 2022. It's about 3:45 right before the market close. Again, presentations made by Rain King LLC for educational purposes only. And I'm an amateur growth stock investor, and I'm not affiliated with IBD or MarketSmith. So the agenda for this brief update is to go over the big picture. I want to share some overview data, and then I really want to get into some of the market action. So long-term chart, monthly chart of the NASDAQ, we're still in these long-term trend line support areas between 10,000 and 11,000 in order to maintain what I call the super cycle bull market. So we're still in that zone, and the market's trying to fight and not break down any further. I've used this before. There's a whole cluster of different levels in here, from the COVID peak to the psychological 10,000 level, retracement levels from the COVID lows to the peak. So we're still challenged in this zone. We have not sold off deeply below 10,000. So I want to share some just quick overview data that I thought was interesting. These come from Bank of America. Bank of America puts out some global fund manager surveys and a couple of interesting pieces of data. The first is these are cash levels of global fund manager survey. And you can see in October that really, really high cash levels. We haven't seen this high of cash level until you go back to 2001. So the importance is, eventually that cash will be put back to use in the market, and it becomes the fuel that could lead a rally. This next chart is capital outflows. The dark blue line also shows allocations to equity. There's a lot of money that's come out of equities in 2022. We've all known that, particularly if you're a growth stock investor. But also, they've noticed that they still haven't seen a huge outflow capitulation yet. So their surveys are showing you haven't gotten people, taking their money out. This is the Fed rate hike cycle. You might want to pause the video player, but this is the question that was asked. Which of the following is most likely timing for the end of the current Fed rate hike and tightening cycle? Now, when they surveyed in the blue in September, you can see about 30% of the respondents said Q1 of 2023. Now, the recent survey a month later in October has said that more people in the survey, almost 38%, think the first quarter of 2023 might be the end of the rate hikes. And you'll notice that the other data, if you look out a little further into the 2023. So this is just a quick check at sentiment. This is the American Association of Individual Investors. It's the bull minus the bears index. This is as of this week. And you'll notice that if the line is above zero, you have net bulls. And in the pink, which is below zero, is net bears. We've been in the bearish, extreme bearish level for quite a while, all the way since back in May. We've hit levels that we hadn't seen in years, which is one of the reasons why this is a sentiment indicator, and we don't use sentiment indicators to time our entries into the market, but we do want to be aware of them because major market bottoms do coincide with very extreme sentiment. But they're secondary. You don't trade off those because you can see we've been in these extreme levels for almost 4 or 5 months now, and we don't know if the market has really bottomed yet. But it's a good sign that we still have some extremes. It's starting to turn back up as we start to get a little bit of a rally in the indexes. So I really wanted to turn and look at some of the market action. I want to get into this a little further and deeper and see what we're seeing. It's a little turbulent. There's a lot of volatility. And that's kind of what you expect at market turns. Things aren't clear, but we are seeing some signs we'll talk about. So I shared this on September 30th. This is the S&P 500. And at the time, I do look at new lows and new highs. And what was interesting is right around September 30th, the index made a new low Um, the previous number of new lows from June was 1,092. And then we noticed that when we broke to new lows here at the end of September, early October, the market made less new lows, 420, as I pointed out. That's what we call a positive divergence because it's saying that possibly under the surface, the broader market is stronger than the index. So that was a clue that um, maybe this is a turning point. So I want to turn to the NASDAQ and I want to talk about the follow through day that we just got last Friday. So last Friday, I've marked on the chart, here's the follow through day. The volume was above the previous day, but it certainly wasn't spectacular volume, but it qualified for a follow through day. So we have to take it at face value. I've noted a bunch of names, symbols here, and when they started to break out and particularly looking at what has been breaking out or trying to break out after this follow through day. So I've noticed the ones in blue are ones that are broken out or still above their pivot points. The ones in gray have broken out or at least attempted to break out, but they've been really turbulent and some of them have actually come back within the base. Shockwave has been very volatile this week. Vertex broke out, then it had a very volatile day yesterday, and it's coming back today. So there's some choppiness here with things trying to go, and the market's just not quite ready yet. But there are some that are holding up. So I've plotted those, and also some of the ones that broke out on the rally we had in July. They're building new bases. I mean, Enphase and CellH are building new bases. ELF has been in an uptrend for quite a while. So it's kind of a mixed bag in terms of the strength of some of the stocks breaking out. Now, the other thing I tweeted about the other day was we did get a distribution day 3 days after the follow through day on higher volume. Um, and, I noted that some statistics from IBD that I had collected from a seminar I went to many years ago, they had done a study of follow through days over a 20-year period. I think it was from 89 to 2009, or maybe it was 30 years, maybe it was 79 to 2009. But they had established that if you get a follow through day, and then within 1 to 2 days post follow through, you get distribution. Those follow through days have a 90%, 95% failure rate. Day three, failure rate is 80%. And probably, which is noteworthy, that if you can get a follow through day and the rally to go for 4, 5, 6 days, that's a good sign that the rally has some legs. So we got a tweener here. We got a day three distribution day. Not great. But today looks to be finishing up strong. So that's a positive sign that hopefully we don't get any more distribution. So that's really interesting. It's to watch. Again, a little bit of a mixed bag in terms of what we're seeing. You still have to be in the right stocks. Some of you have probably tried some breakouts here, maybe, and gotten stopped out. Others, if you're positioned at lower costs, you're probably okay. Um, Noteworthy is there's a lot of other stocks that have taken the time because we've been basing now for a while. There's some pretty good watch list names that are building bases. Many of these names have some pretty good earnings and sales. But I will caution a number of them have earnings coming up the next 1, 2, 3 weeks. So you have to be very, very conscious of avoiding getting a position size in a way that you could get hurt by earnings. And we saw that with Wolf this week. But that's a positive sign that there's stocks that are getting to that 6, 7, 8 week base time period. The other thing that's noteworthy about the chart happened a couple of weeks ago. We had this day right here. I think it was October 13th. This is a really important day to me because the market had every excuse to sell off hard because the news that day was the CPI came in hotter than was expected. And you would have thought with that kind of news, the market would have tanked. But instead, the market sold off and immediately reversed higher, closing near the peak of the day. So this is noteworthy because you're looking at it and saying the market has stopped going down on really bad news. And that's one little piece of the puzzle that we're looking for, that maybe the market is stabilizing and maybe willing to make a turn. So it's just another piece that you want to keep in your in your kit. Okay, so let's look at a couple of relationships here. This is the dollar. Notice that in the last few weeks, the dollar has leveled out and actually turned down a little bit, which is actually good for stocks. You notice as the dollar has come back down, you see the NASDAQ and the S&P have started to rally. So that's an interesting development. Also noteworthy, we know this week we had big tech had bad earnings and they really got hit hard. And so you can see the QQQ here. It's making even newer lows for the year. This is big cap tech with bad earnings, really taking it down the chin and possibly holding back the broader market. Because if you look under the surface, the IWM, which is small caps, and the MDY, which is mid caps, you'll notice that they are starting to grind higher and they're not making new lows. So we're seeing a little divergence in some of the smaller cap, mid cap names, which is actually a good sign to help lead the next rally. So I wanted to just come back to this kind of dial of the economic cycle. We're late in the economic cycle. Whether we go into a recession is not really known yet, but we're certainly in this kind of wedge of the cycle. If I were to look at it on this chart of the bull bear cycle, the stock market, we're probably in mid to late bear market territory as we go into 2023. I know that a number of people have mentioned that the oils are still strong. They're a late economy group. So I wanted to talk about them a little bit, energy and oil, share my perspective on that. So what I'm showing here is this is the XLE in black and the XOP, which is the oil explorers in the gold color. And I've just brought this back about a yearly chart. And I've just shown you that the oils have been running, have had some real good progress. Last November, December, they broke out and they had a very steady accumulation uptrend. You'll notice that there were small bases along the way as they made their highs, and they really topped out in late May, early June is when the oil and some of the energy names topped out, and they had a very hard break, very deep correction, and some of them have started to come back, and they've been kind of trying to build a base, and it really is what I would call a wide and loose late stage base structure. The question is, some of these stocks are setting up to break out. Some of them have broken out, and you have to ask, are the oils going to have one more last move? I will share as you get later in the move, some of these deep corrections are faulty bases, and they tend to fail fairly quickly if they do break out. So to take these indexes and to apply it to a chart, I just put up Devon Energy here. You can see in perspective, we're looking back all the way back to the COVID lows. And what I wanted you to look at, this is kind of an educational point, early stage bases in a stock's move tend to be shallow and not very long. In case this is like a 5-week base. See how it's kind of in this box? It's not very deep, it's not very long. As you go up the uptrend, you tend to see the bases get wider and deeper as the trend becomes more obvious. You can see this base is a little deeper than the previous one, and it took a little longer to complete. Stock moved up, then this base is even longer in time, and it's still about a depth that was similar to the last base. And then the stock had a nice steady uptrend along the 50-day moving average. And when you put it in perspective, look at this latest base. This is really the deepest base of the Devon run. And it's also the longest base. So it's what we really call it wide and loose. And you'll notice that there's a bunch of spreads in here that are pretty wide relative to some of the tightness we saw in the uptrend. And this pattern of kind of tiny little boxes at the beginning of a move, and then wide, long rectangles, you will see this in many, many model book stocks. It's usually an indication that the move is late in the game. I put it up here just to give people my perspective of some caution on the oils. They may work. They might continue to make a run and have another move, but it's also possible that these things could break out and fail fairly quickly because they are late stage. So with all of that said, the market seasonality is entering a favorable period. You can see here, this is the calendar. Here's November and December, and November and December typically are very strong for the market. And these are the results. 1950 is the black bar. The blue bar is in the past 20 years, and then the past 10 years is in orange. You can see the seasonality of October, November, December is a very strong period for the market. We just came out of August and September, which are weak periods for the market. So that's a plus. We seem to be going into a favorable time of the year. So if I were to try and give a scorecard to what we're looking for in a market bottoms, here's how I would see it today. We want to see rally attempts with breadth. With the advanced decline line improving, we want to see leading stocks moving. We have seen a follow-through day. There are some leading stocks, but not a huge amount of them yet. And the advanced decline line has not been super strong yet. So I give this kind of a B- rating. We'd like to see a positive divergence. When the index makes a low, we want to see fewer new lows. I pointed that out on the earlier chart. I think we are starting to see some positive divergences underneath the surface, as well as small mid caps starting to outperform the larger caps. A follow-through day. You want to see a really strong follow-through day, big volume. I think this is a C+. The percent gain we had a week ago was not great. The volume was just barely average. And we've seen, some stocks have followed through, but not a lot. And some of them have broken out and reversed. So that's not the healthy action we want to see. I think this is really still about a C+. Sentiment has been at extremes. I give this an A. There's a lot of different sentiment measures that have showed we're very, very bearish. And many people are extremely bearish. But I think that's an A on the scorecard. The news has been horrible. Inflation, rates, the Russian invasion. Again, I think we certainly think the news is really, really bad. Also, the next one is, our growth stock names, do they stop going down on bad news? Certainly, big tech has not had that happen with the Amazon and Google and Meta. They had bad earnings and they sold off really hard. Google had a really bad reaction. So that's not great. But if we look at the market, the broader market, as I mentioned, the bad news of the CPI number a couple of weeks ago, the market did not sell off. So it's kind of mixed. I give it about a B-. And then quality bases, new names setting up, relative strength names. I shared on that slide earlier, I do think there's a number of stocks that are getting some good bases that are 8, 10, 12 weeks long that are showing signs of accumulation. They have good earnings and sales. Forecast for 2023. Let's see if they can continue to fill out their bases and possibly break out or give us some entry points. So I think this is actually a much healthier one than we were 3-4 months ago. So I give it a B+. So with that, I just wanted to end the session with winners and losers too. This is the second part of my Blue Sky talk. We've just decided the date is going to be November the 9th at 7 p.m. Eastern. It'll be a virtual event. I'm going to tweet out the link later today on how to sign up. Or you can also sign up by going to the Boston IBD meetup. You can register there. There'll be a link to take you to Zoom. You must register for the event. So this is going to be a longer presentation, lots and lots of examples. It's going to bring your notebook. It's going to take at least a 2-hour session, probably with some Q&A. I hope to share a lot of other practices and things to help you be more consistent in your trading. I'm looking forward to it. I've learned a lot just putting it together. So I hope you can join me for part 2 of Winners and Losers. And that's all I have time for now. I really appreciate you. And if you want to give me a comment, would appreciate that too. My YouTube channel, I believe YouTube is assigning new handles to different accounts. My new registered handle will be Rain King LLC. So that'll be the future way if you want to get to me quickly on YouTube when that becomes active. But you can join me at Twitter as always. And I look forward to seeing you all at the next meetup. Thanks, everyone.